coming in. I'm still admitting people, so let's see how many more before we start.
Recording in progress.
Okay, it's 8 o'clock now, and so I guess I don't want to let people wait too long. Today, as you can see, you may see my profile picture is Darren, but actually I'm using his login. But don't worry, I will be hosting today. Okay, there are people still coming in, so bear with me trying to admit them in as I play with the thing. Let me see. I'm going to share the site. Let's see. Is it? Oh, now I think there's still new people coming in. I'm just trying to make sure I admit all the people there. Yet. Probably too many slides. Let's see. Okay. It's one. Let's see. More people admitted. Let's see. Any more? Okay. Stage. Okay, I think I better don't delay anymore. So let me start off. Today we are talking about module 6. So again, thanks for joining. We have about close to 30 people coming in tonight. Thanks for the time. Today, I will be covering about financial metrics and market trend, more on the fundamental analysis and technical analysis. So bear with me, about 60 slides I have over here. What I will do is I will cover a bit more on the what do you call that, the technical part of it, or the theoretical part of it, before I go on to more the practical usage of it towards the end. So I will try to do 1 hour on the fundamental analysis, probably a slightly lesser time on technical analysis. Then there's some practical application later on. And as usual, we will be recording this video, and we will definitely be sharing into our area, what they call it, online access, that you guys can take a look at it later on. So I think as we speak, there are still people coming in, so bear with me if I have to change. Time is about 3 minutes into it already, so I think I better don't delay anymore. Let me just jump into it. As usual, a disclaimer. Information that I'm going to share today contained from public sources. It's also a personal opinion, or at least from all the sources we come up with the presentation and the information for your sharing and learning. If you need to have a specific financial advisory decision or information, please look out or seek out to the advisor. Any presentation on here is for general circulation and does not take into account any specific of your investment in objectives and financial situation. So do seek financial advisor if you need to. Okay. Okay, with that, oh wow, there's more people coming in. I hope you guys can hear me. So press start of 1 if you can hear. I just now check and everyone says it's okay. So I assume it's okay. Pause for a while. Everyone can hear me well enough? Good. Good. Thanks. So again, as I mentioned earlier on, that we'll run through very quickly from a theoretical or the what do you call that, practical use will be talked about a little later, but more on the theory and the fundamental information of it. So with that, let me jump into what other content today. Today we will talk about, oh, hang on, let me just, I need to kind of minimize some screen, otherwise I have something that will pop up in a presentation. Okay, we'll touch on 6 topics: fundamental analysis, financial statement and key ratio, what we look out for, quantitative analysis and valuation method using some of the ratio, and then we'll touch on the technical analysis and how to identify trend, patterns, key technical indicators. And of course, finally, I want to put in a bit of practical application, also idea for you all to look at it. The one thing I would want to do is, of course, after the first 3 topics, hopefully we have a hot stop, 5 minutes break before we come back and finish off the other rest. If you have any questions, feel free to put in the chat, but I will try to kind of answer towards the end as we go into the next session, like at the end of the first hour or along the way if I see appropriate. Okay. With that, let me jump to the first thing. What is fundamental analysis? I'm sure a lot of people knows what is it. It's kind of a way to understand the basics and for smarter investing, for better investment that you can make decision better. I always associate it to more evaluating intrinsic value. It kind of focus on examining the financial industry position and economic indicator of the company and all this thing, and then differentiate what is price versus what is value. So as what Warren Buffett always say, price is what you pay, value is what you get. So understanding fundamental analysis do help you to gauge the right value before you jump into any of the detail in there and that may have impact on that. Okay, just want to make sure there's no people that I miss out. I have to admit. Okay, looks 3 and the waiting room view. Let me see. Okay, okay. Okay. So next, let's jump to why use fundamental analysis. Okay, it's actually to look at using it. It can help you to look at exploring the mispriced stocks. So if a stock has dropped a lot and the value is there, maybe it's a good opportunity to catch it. It can also find overvalue, undervalued opportunity, but also can find overvalued product that maybe you should be letting go. So I mean, those are the things that it can go both way. The other thing is also reducing your what you call it, investment risk, because just in case that you went in at the wrong price and the value is not there. And then also using those fundamental data to make decision based on data rather than emotion, because a lot of time we tend to be more emotionally driven. We are human. Human tends to have emotion. Last session on module 5, I did talk about the emotional bias that we have, and a lot of time it built on certain past behavior or past experience that drive us into a certain behavior and all those things. So those are the things that will cost us big losses and everything. The last thing is, of course, you knowing the fundamental data and knowing the growth of the company, their PE or their gross margin continue to grow, you can explore to build a more long-term wealth creation, a sustainable investment return. So that's why you want to use fundamental analysis, and kind of the key essence of why we want to do that on those areas. Okay. Next. So key area of fundamental analysis, I think if I look at it, the first part of it, I would say is always looking at a financial statement, because financial statement is like a report card of the health of the company, in terms of their profit and loss, balance sheet, and and cash flow and all things. It's kind of giving a gauge on, is this company doing well or not doing well? How is it doing well? How's the inventory going around and all things? The other thing is using those information, then it will start develop into financial ratio that helps to compare its performance. Okay. And these are more the data-driven decision. Okay. But data sometimes, that is only there's such thing called statistical data. Okay. Data can be manipulated. Example, I'm used to run the operation for some businesses. At the end of the quarter or beginning of the quarter or at a certain time, we may pull forward or push out to help increase our revenue or our reduce our inventory to look good on our inventory turn, cost of goods sold, and kind of thing. Because when you delay receiving product, you reduce the inventory holding. So that's why the financial ratio is good, but there are also smart people that know how to, I wouldn't say totally massage, but at least manage it to better look. The other thing is qualitative. That's non-numerical. Sometimes it's from the statement they say or in the news and all those things that you look out for. Then using those, you do some kind of valuation tools to calculate what's a fair price and do macro analysis. So that's kind of key area of what they call it, fundamental analysis that is used for. Okay, from first financial statement, go all the way around, and then of course macro is economic situation you decide. So first part I finished. Second part is about financial statement. Okay, financial statement. I guess everyone knows that it's like a report card, and when we buy a company or buy into, let's say, SGX, and we would like to look at whether it's growing every quarter or every year, or how's your profit margin and all things. So that kind of the income statement showing the profitability of the company. And then, of course, as you also dig into deeper, you also look at the balance sheet, whether there's accumulating more liability or less liability. Is there a capital injection or equity injection? There are more complex ones where share buyback will increase the equity, reduce the outstanding share in the market, and it also has impact on the PE ratio and all things. So those are more sophisticated. Of course, cash flow is the company having sufficient cash flow to keep their business going. So a simple income statement, just kind of wanted to start with, there's always income and expense. Let's say we have one of these case study, you have revenue, you have cost of goods sold, income from investment. So which other item will be part of income? Maybe what we will always look at, whatever that bring you money into your pocket, it is called the income. So in this case, of course, not going to more asking everyone to kind of look into individual what is the right kind of area. I would say, hang on, somebody coming in. The revenue and income from investment are the main income coming in. And of course, the other rest like cost of goods sold, and then travel expense, research and development, admin, and all the other rest will be part of expense. Okay. So of course, with that, then you can calculate what is your profit. So what's profit actually? Any guess, guys? You can put in the chat if you want to, but very quickly, I guess 150,000 plus 10,000, 160,000. And the other balance, you have 60 plus 5, 65 plus 10, 75, plus another 10, 85, 95 plus 3 is 98 and 100,000. So 100,000 minus 160 minus 100,000 is 60,000. That's your profit. Right. So a very simple kind of example I'm kind of putting here. But income statement, as I mentioned earlier on, sometimes there are cases where company report pre-booked revenue. And many people place the order, but they may not have collected the good. So there's certain guideline what is acceptable to kind of book as a revenue. It depends on jurisdiction of the country it is in, and also the practice in the company. So those are the things that will determine how they book the thing. So like earlier on, I mentioned cost of goods. So once the goods out of the door of the factory or the company is considered sold, right? So to some extent, it will be considered as part of expense down there. So that's another reason why I mentioned earlier on, when we are in corporate, a lot of time we play with these things. And sometimes we reduce, you hear things like, oh, travel freeze. Travel freeze means you cut the travel expense. Because if you cut the travel expense, you reduce your expenses in the in the quarter, Likewise, research and development, you may delay it, or admin and general expense. So this is how you play with the thing. And a lot of companies just have to manage their number every quarter. The difference is, of course, in the US, because the investors are more short-term thinking. So they look at the quarterly result very tightly. And that can be good and bad, I would say, because sometimes it means that people are very short-sighted, and they have a tendency not to observe the thing correctly in terms of whether maybe you have a short-term gain, but your long-term losses that would have impact on that. So get that kind of income statement. Okay, cash flow statement. Actually, this is kind of a lot of people kind of ignore cash flow, but only look at income and expense. Partly because it is more difficult to dig into this, although it does impact how well the company is making its profit and all things. A cash flow is like, example, in an operating area, it can break into three key areas. Okay, operating area, the operating cash flow, normally we call it operating cash flow, which usually it refers to things you happen during the operation that generate the income or generate the expense, and what's the cash flow that come in, a cash flow go out. So example, in a coffee shop, okay, a cash flow for a positive cash flow is when they sell for coffee, you have the cash receive. Okay, that's a cash flow. Or in software company that provide what they call consulting. Okay, the service that's being given, they consider as cash flow coming. And a lot of times, sometimes they sign on contract. So they may have to, depending on the contract duration and affected in some of this area on, does it accrue on every month, how much is being covered in the whole contract period and all things. Likewise, expense means things that you use for the operation. For example, material, utility, people, third-party services and all things. As for investing, and that's where sometimes things can look very good on a total cash flow, because people bring in more cash. So the cash come from when you sell a business, or you sell a property, or you sell a plant, or you sell something, you bring in a lot of cash in. Okay, so that become a cash flow positive from investing activity. But likewise, if you purchase a factory or purchase a new machinery and all things, it becomes a capex item, it could be a cash flow negative. That means it's negative and minus away from your area of your things. So likewise, the financing activity, sometimes it becomes like when you issue new shares, or you get a loan from the bank. It looks positive, but actually this is liability to you, but it's still a cash flow positive into your cash flow statement. So then, of course, when you pay back your loan, or you use your company cash to go and buy your share back, that means your employee share buyback kind of things, that is also a negative cash flow. So, or you pay back a debt. So those are the things that can impact cash flow. Why cash flow is important? I would say it's like the blood in our body system. If you have enough cash to move around your body, you won't die, right? I mean, if suddenly your cash, you don't have blood, then the business will not survive. A lot of the company actually went into liquidation, partly because the working capital ran out. Okay, that means your cash flow ran out, and they couldn't keep the business running. A lot of time it's not their asset may be a lot, but you can't sell the asset fast enough to cover the cash and all things. So cash flow become a very important thing that we should look at. So example of I use SGX, I think 2024, last year's report. If I look at this thing, you look at a few areas. Of course, you look at the latest result in 2024. A lot of time we look at, of course, is it growing? Is the thing growing year to year? If this growing, of course, is good. The business is growing. As you can see from here, it's 3.1%, 2.1%, and is it 3.3% kind of growth and 4.7%. So those are the percentage they talk about the growth in the thing. But you can also see from the statement of cash flow. Of course, this SGX probably is not a good example because their operating activity is not as complicated. They probably have more financing and other activity in there. But in a way, cash flow from operating activity shows that, okay, it's growing in cash flow in there, okay? And then, of course, you will see that this is all the different indicator on is their operating margin growing, is their cost to income ratio, their gearing ratio, and all these different ratio that they have in there. So this is one way you can pull some of the data from financial statement about the business condition. Usually when I look at any business, if it's growing, it's less of a concern, okay? If you see a net margin, this thing is coming down, or you see a divergence. That means, let's say this is coming down, but this is growing. That is either the business is doing very well in cutting their expense or controlling their operating expense. That's why the profit go up. But the top line is not coming in. It's also a concern because that would mean that the business, whether it's sustainable, because you need the sales to bring in more cash and all those things. So that's kind of area that we always have to be mindful of in order to know how the business is running and all stuff. Okay. Let's see, next one. So where to extract company financial statement? There is many different way. Of course, you can go to SGX portal, you can go to Morningstar, you got investing.com, you can even go to our Philips portal and you can look at that. Just give you an example. If I could now on my statement, let's see. So can you see this on, this is our portal. So I can go to news, research, stock analytic, you can type for SGX and then it give you some of this information. It can give you the past data, even part of the trend and all things. So you can roughly know, and you can even look at semi-annual, quarter to quarter. This is kind of a June to December, 6 months kind of window. Is it growing or not growing? In that case, then you look at their income statement and all things. So this is just one example that we can do on there. Okay. Wait, let's see my presentation slide. Okay, back to here. So other area is like in US stock. There's a lot more platform you can pull some of the information. I use quite a bit of investing.com. I use Morningstar. I use Guru Focus. Those are a quicker way to find some info. Of course, you can use other broker information like Futumomo, or the Tiger or whatever is platform that you may have. You also have some of this capability to pull the information. You can even go to the company website to extract the financial statement. Okay, so that's kind of the thing about the financial statement. Then of course, with the statement, with the information, you start to calculate the different ratio and how does it work in our things. So you will have big things related to profitability, net margin, ROE, talking about earning power, liquidity, current, quick, short-term, solvency. That means how quickly the cash is moving in or the money is coming in to help the business. Leverage, debt to equity is more about understanding is the company taking a lot of financial risk. Of course, efficiency is about asset inventory turnover. How well are you making your asset work for you? Okay. Okay, so now it's a bit on the dry side. We're going to talk a bit more on the profitability ratio. What does it mean? Gross margin, basically, basically a measure of how much company earn dollar sales without operating expense. So basically it's minus cost of goods sold. The key word is, and again, industry by industry. So let's say if you are not a manufacturing industry, you will have very little of cost of goods sold. Like SGX, what's the cost of goods sold? Probably, I'm not sure. The GM is very hard to calculate. I think they will look at net margin more than, because you don't have a product that's selling, probably a very small amount of number in there. So that's why industry has different kind of numbers in there. Net margin is basically after considering all the expense. So operating expense, including HR, including R&D, whatever it is, IT and all the expense you pay. So this is purely when you sell a product. This is after taking care of all the things. And earning per share is, of course, you look at a measure of profit it makes per share you own. So there's you notice there's this thing, the total share outstanding in the market, or total outstanding share here, right? So what it means is, uh if you keep your numerator big and your denominator small, of course your EPS will continue to grow, right? So that's why when a company buy back the share, sometimes it means the outstanding share in the market lower. So the EPS may look good and the PE may look good. So this way to the smarter CEO actually play around it. Okay. Other profitability or efficiency ratio, I would say return on equity. So this is more a measure of how company uses its equity. Equity is when you set up a first company, or when you first start up, you have the pay up capital. Your pay up capital is your equity. Then of course, as you go along, you may have reserve capital put in there because your profit turned into this reserve capital, and so you change your equity too. So ROE is always about earning or net income divided by the shareholder equity. And then, of course, multiply by 100%. Again, different set of company industry has different kind of gauge. And there, of course, a standard gauge will be 15% and above, typically is considered good. Again, this is the standard, but if you look at it, ROA is another measure. It's about how well you use the asset. So you notice that because the asset base is kind of a different scenario. Sometimes the asset can be, or you collected a lot of cash from your, what do you call it, in a bank, you collect all the deposit and all the things. So this base become very big, right? And the income may become very small. And then so the percentage will be very different from a typical ROA that we look at 7%. So every industry is slightly different. So sometimes it's good to compare industry to industry rather than just take ballpark number. And next is inventory turnover ratio. It's more like cost of goods sold divided by average inventory. Actually, I repeated this on the latest slide too, but don't worry, it's just a way of correct efficiency. Oops, I think, yeah, these are the way to look at efficiency of the, actually, if this last one is actually the efficiency ratio, how your good is able to, so that means, let's say a turn of 5. What does it mean? It means that on average, your inventory turn 5 times in a year. That means your asset inventory can make 5 times the revenue or 5 times the business. That's kind of, the bigger the turn means the more efficient your asset is moving. Okay. So that's another area that, for your knowledge, in theory, this is how I look at. Okay, the other one is liquidity ratio. Liquidity ratio kind of look at how liquid your asset is. And so because you have one side is the asset. Oh, sorry, I'm spelling mistake. Asset become assets. My fault. Typo error. I just realized myself too. Okay, current ratio is always about current asset divided by current liability. So when you buy certain product inventory, you may still have a liability where you have to pay for whatever that is current liability is a current. When you place a PO, you bring in the inventory. You have the inventory in your place, but you also have a payment that you need to do for people. So how well you collect the money, how well you use your asset versus how well your liability is a way to calculate how current ratio. Then of course there's a thing called quick ratio. The quick ratio is another way that is a little bit more stringent. It measures the short-term liquidity. So the keyword is short-term. It's obligation with most liquid assets, so non-inventory, cash, security, account receivable. So they only consider this current asset as total asset minus away the inventory, because inventory is the one that you remember the earlier slide I have the inventory turnover. I mentioned 5 turn means the inventory turn 5 times in a year. It measures how fast or how efficient your inventory is creating business. So when you use quick ratio, is calculating how much of liquid cash that is able to over the liability. So anything that's greater than one, bigger than number, it means it's faster the turn. Okay, so that's kind of liquidity ratio. Next, debt. Debt is leverage ratio. I always call it costly and kill in bad times. Usually in a good time, people forget about that. I always remember one of my big CEO or one of the company founder always say, we don't die of indigestion. Business don't die of starvation, but business die of indigestion. Okay, so that means sometimes you take up too much business and take up too much debt, and then in the end you cannot service it, you die. So that's always the risk down there. So a reasonable, typical way of measuring debt is always looking at debt to equity less than 0.5. What I mean is that your debt that you have. So let's use a household as an example. That means let's say your credit card debt is 5,000, but your equity or you have your liquid equity is 10,000. Although maybe that's not so good an example. Let's say a housing loan you have 1 million, but your total asset or total equity that you have in supporting on your personal household is 2 million, then it's 0.5. So then it's quite, that means anything happen, you still have you can liquidate some of equity to pay up the debt. Okay. I use household as a simple way of measuring, but in business, of course, it's a lot more complex. You have long-term debt, you have short-term debt, and you have also credit term with the customer, and I think those are also actually credit term with the customer, credit term with the supplier. It become one is that, one is become your prepaid cash kind of thing. So these are the things that can also affect. But debt to equity does give you how much you are leveraging. Okay. And the other measure is asset over equity, which is for finance company must be greater than 15. So that's another way of measuring financial company, because financial company normally this what they call it, the flow is not so much on debt itself, but more on asset they hold for their business growth. And all that asset is like when you collected the saving from what they call it, or the depositor is use your asset too. Although when you look at the other end, it's always the liability. So how you look at the number here and there. Long-term debt coverage, this is where your current income for most recent year times 5 is greater than long-term debt. This is more like a way to look at it, means that if your current income for most recent year, that means let's say your business is doing 10 million and your income is doing 1.5 million, but 1.5 million and then your long-term debt is 3 million. So 1.5 million, 3 million over 1.5, your 1.5 million income times 5 is definitely more than your long-term debt. So that's kind of safe. When your debt is bigger, is bigger than your five times of your long-term income, then of current income, then it becomes a risk that you may not be able to sustain it. So that's kind of the common measure that we use for fundamental analysis. Other measures here is also, I mentioned kind of briefly earlier on, cash flow from operation, which is more like positive and uptrend, is ideal. So using coffee shop as another example, okay. Coffee shop, what is the biggest expense? Typically, the rental. The rental could be a big expense. The coffee bean is one of the expense. Of course, cash from selling coffee minus cost of coffee. Cost of coffee could include coffee itself, the label, and rental, right? And a lot of time, if you look at it, why a lot of kopitiam cannot survive? Because there is not enough cash to cover their daily requirement and expense. So when you start out a business, you put in certain capital and you hope to reach a certain level that you're self-sustaining. Then you don't have to inject more cash to keep the business running. So that's where cash flow for operation become very important to look at. And there's another measure called free cash flow. Normally it means a cash flow from operation minus capital expense. In some business, especially more asset heavy business and all thing, factory and all thing, you have certain capital expense at every, let's say semiconductor, TSMC, they have huge capital expense every year, and they have to depreciate based on certain depreciation profile and all thing. So this one will give you a measure how much free cash available after considering the capital expense for equipment. So in the case for TSMC or even our what you get Chartered Foundry and all that, you will notice that capital expense is a big item, and the free cash flow, if it's very negligible or negative, then of course they will always have to depend on injection or investment income, or rather financing income to support this thing. But that is not long-term sustainable. So they have to grow their operation in order to do that. What is the difference? Okay, I answered that in a short while. Okay, I saw a question coming in. Okay, that kind of capital expense are fund used to acquire or upgrade physical, such as property, equipment expense, usually for new project or expansion or investment in the future. So capital expense typically are those that can be kind of depreciated over a fixed time frame. So in the past, when 20 years ago or 15 years ago, laptop or PC is considered a capital expense, but now it's considered as operating expense because it doesn't last that long anymore. That's one thing. The other thing is the cost of the laptop or computer become cheap enough. It's no more considered a big ticket item as capital expense. So capital expense do change over the years on the terminology and everything. Okay. So since I have this junction, I saw this question about what's different between your cash flow from operation and gross profit. Cash flow from operation is, as I mentioned earlier, is about not about your income minus expense equal to your gross. Your income minus your cost of goods sold is called gross profit. Okay. But in this case, cash flow means you have to consider your cash flow from selling a product and your cash flow from expanding on this thing. So there is a area of certain fixed expenses of the operating expense considered into the statement of cash flow from operation. It's kind of closer to a net margin, but yet not 100% to the net margin, because net margin has other SG&A inside there that is kind of normally is kind of operating expense. That kind a bit different from that perspective. Okay, cash flow from operation usually is you look at the actual cash rather than you look at end of the period. So I would say yeah, end of period because income expense sometimes you have a certain way of depreciating a certain step jump on certain expense on a certain period of the year. Okay, but cash flow from operation typically you try to calculate the actual cash movement rather than income and expense only. I hope it explained. Okay. Yes, it's a bit closer, but it's not so close to gross profit, more closer to net profit area. Okay. Okay, I'm moving to the third part. Hopefully by 9 o'clock we finish this. This one will be talking about. Okay. That's it, qualitative analysis. So we have talked about quantitative, where it's data-driven, we can calculate the number and all things. Qualitative analysis is more about brand, patent, IP, network effect, a lot about more something that is not so easily quantifiable. Leadership capability, succession planning, a business model of the business, whether it's revenue sustainable. Example, the last few years we have virtual reality, people burning money like crazy, means they are banking on the idea, but they are not actually having income yet. So it's more on how future is going to be like. So the revenue, whether it's sustainable, is unknown. but it's a lot of selling on hope. Scalability, also the business, whether it's able to expand. A coffee shop can expand to 2, 3, 4, but is it easy to expand? Certain business may not be so easily expand. Maybe let's say a barber. Okay, you only one person, you can hire other people, but other people may not be as capable. So your scalability may be the constraint, besides, of course, space and all that thing. Okay. Let me just finish this, then maybe I come back to the question that's in there by Ray. The ESG factor is only recently, I always feel that this is a bit of, I would say, a Western way of making things more green and more sustainable for the future of the humanity. But yet it's also another way to depress the latecomer or the late developer, so that you cannot overtake them so easily. So ESG become a factors that put inside there. And I always look at ESG on two sides. Because they are more developed, that's why they don't have to burn, or you don't have to consume so much electricity to make the product. So the ESG factors looks good. But it's a good factor to help everyone to achieve a greener and sustainable. And it become an important thing. Until recently, I think the climate change and all thing is showing that this is very useful to watch on. Okay. So I'm also using SGX report. Maybe Ray, you hang out until I finish this, then I cover your question. Okay. Example SGX report on this. This is Koh Boon Hui, one of ex HPMD. I met him in person before. He's always very charismatic, very far thinker, very interesting person to know. He's always have great idea. But when I read through this report, and a little again, why call it qualitative? You read between the line what he's trying to say and all that thing. You will notice there is highlighted some of those areas. What is the I mentioned about heightened geopolitical situation. There's evidence that their cash equity business need more attention, which is basically, if you look at the SGX, there's less IPO than past years and everything. So that's kind of equity business in there. Required Singapore Dominica to kind of listed in Singapore rather than listed overseas, because you lose some of the profit and all that thing, or you lose some of the possible IPO income. So SGX is like when you get people to list, you get, a company listed in SGX every year have to pay a couple of million just to keep their listing there. So imagine you have less and less company listed in Singapore, then you have an impact on your revenue and all those things. So I won't go into a lot of detail, but there is things that is saying like high liquid market drive valuation paving the way for IPO. So whether it's SGX, okay, I happen to got a chance to know people who has listed in Hong Kong Stock Exchange, Taiwan Stock Exchange, Singapore Stock Exchange, Malaysia Stock Exchange. There are different regulation in there. There's three parts in there that impact a person why you want to decide to put your listing in Singapore or other country. One is, of course, ease of listing. Is it easy to list in one place? Number two, is it easy to get capital? Because when you want to list a company, you want to have people buying your company. If there's no angel fund or more liquidity in the market to buy your company, then you're very stagnant. Your PE is very low and go like when listing. So these are the qualitative part. And the other area he mentioned, FX, and it's interesting, SGX has been focused a lot on FX and commodity business, which is why they have been growing. But in terms of because there's a lot of detail in here, but you can see that he started to focus more back into the IPO requirement, how to restructure the company. Of course, this is another letter from because it's 3 pages. Oh, it's 2 pages. I can't squeeze everything in here, but so I just extracted some of the thing in here. Notice there's one thing called the market position for our flagship of CNH and INR futures. These are basically Chinese denominated and Indian denominated futures. on commodities. So that's their strength in some of this area. The commodity is the area, but it's also being used. Singapore exchange regulation is always been seen as a very safe, Singapore is very governed. The governance is good. Okay, but because being governance good doesn't mean that it's good for investor. If you look at Malaysia stock, they can swing much faster, but because they're less governance, which means there's also a risk that go background. Okay, so there's always a balance in there. But I can see from this report there is an intentional start to push for at least make more easy to be listed in here and more equity liquidity in this area. And you also notice there's some words of appreciation. People are leaving, so some of the old guards are leaving and all things. So there is some intention to change blood, I would say. So it's in between the line. You want to read and understand what does it mean and all things. So these are qualitative things that you try to read in between the line from the financial report, especially letter from the chairman, letter from CEO, and also last one, the auditor. I didn't put in here. The auditor will always say whether this report is, they cannot say it's because they are the auditor, they cannot say it's not good, but they will put in the words that make you feel whether is it credible or not credible. So that's why you need to read the report of those areas. So financial, of course, these are the things that you pick up from there. What is their growth? And a lot of time they may mention, oh, the future growth is in what area? Yeah, in this case, you can see that there's a lot of focus on one of the few key I picked it up was you see the listing revenue very small, 5.7 million. Where's the big revenue? Trading and clearing. Where's the treasury and other? And the commodity futures and all that. So you can see that SGX not so much dependent on the IPO or those companies listed in Singapore. There's more and more getting private rather than listed. So it's also a concern to them. But they're also quite good in diversifying to commodity and derivative. So that's also the strength they have. But they are seeing the threat also, especially if you look at other regions. We have Malaysia, Hong Kong, and other places. Okay. Then of course they look at the value, what's the strategic priority. Again, in this report, I kind of look at it is that they are talking about the avenue of raising capital. The keyword they keep repeated is a trusted Pan-Asia multi-asset across the region. So you can see that they are trying to focus on multi-asset, and also Asian, because as Asia grow, as Southeast Asia grow, because of their collaboration with ASEAN and all things, there may be opportunity in there. So they try to expand their network and partnerships. So those are the things they mention. Of course, they also mentioned about sustainable, what they do, what they lead, and all things. So again, when I mentioned ESG is part of the expectation of all corporate. So they have to put some effort in there too. Okay. So with that, I kind of wanted to jump into a bit on something that is more on value investment kind of thing. Business value come from its economic mode, I would say. The term economic mode is actually like I mentioned, like you can see that this is an old castle, right? Old castle in an old, whether it's European or even in, well, less of China, but European, they always have this water back beside it. It's kind of to protect them from attack and all things. So an economic moat is kind of a way, ability to have a competitive advantage over its competitor. So this competitive advantage is like this river that protect them from intruder or competitor and all things, so that they can keep their long-term profit and market share from competing company. So like medieval moats serve to protect the inside of the fortress. Okay. So a lot of qualitative question we typically ask is the business generating enough profit for the next 10 years? So that's something when you go into buying a company, is this company going to stay for the next 10 years or next 5 years? As if you're going to be in the next 5 years window, will the business be able to continue generate profit? Okay, so one is generating profit, the other one is will it be in the business? Okay, will it be special? What is so special about this to allow you to survive for the next 10 years? So those are questions you ask to figure out what is the mode, what is the strength or the protection they have over here. Okay. So that's kind of economic mode. Then I kind of because this can be a 2-hour session just talking about the different mode and all things, but I kind of cram it down to ranges of business economic mode, I would say. And a very simple, I would say, is like things related to toll. It's like we go to ERP, the took you have to full control the ERP, the only country or the only authority, then transport authority. Okay, they determine what is the price and all things. Likewise, telecom is also a toll kind of service. Legal protection, of course, you have things like you know, related to license of telecom needs a license, a certain thing needs a license. You have pharmaceutical, which have certain patent that they continue to pay for it, trademark or trade secret that control the formula or whatever it is, right? So those are more that protect themselves. But like pharmaceutical, even their patent has certain lifespan. It will expire and then become generic drug can come in. So those are the things that you need to understand. What is their legal protection for that? Economy of scale. So things like you know, Sheng Siong or NTUC, they have certain scale of. I mean, if you look at US, you talk about Walmart, they are big enough. They have a, so they can become a low cost producer. They have a network, a distribution network that help them the strength. Switching costs. Let's say you're an Apple user to switch to a Microsoft, it become very painful. So a switching cost could be an area to become a protection for you. Okay. So those are things that, and then a brand loyalty. This is quite interesting. A lot of company, very hard to measure brand loyalty. Nike, I use the word Nike. It's a brand. You know, the t-shirt could be as cheap as at cost price, maybe a couple of dollars, but it's selling at, you know, on the market retail 15, 20, or even close to $40, $50. But that's because it feels good with the print or whatever it is. It's supposed to be controlled with the quality and all things. So brand loyalty there, people feel good when they buy the brand, right? So on the other kind of more quantitative way of looking at mode is always talking ROIC greater than working return on invested income greater than weighted average cost of capital. This one is a more complex equation, so I will not touch on it today, but you can do Google and you can understand a bit. There is Google Focus can do some running of this for company. What is their ROIC versus WACC to give you an idea what is it. So there's a lot of information in the market that you can pull it out, especially for US company, not so much for Singapore companies. Sometimes this may need a bit of time to work on it. Okay, I'm going to jump into the last few slides, which is talking about, you know, beyond this, we also need to look at the industry growth stage. Let's say printing industry. Okay, printing industry used to be a growth stage in the 90s, in 2000s. Printing as in physical calendar printing, you know, paper printing and all things. But this day, printing industry is a sunset industry. Why? Because people switch to PDF. People switch to, you know, it started with what do you call it? This, you know, remember when we will receive a thick copy of the annual report. Then it become this, you know, CD. Now it's please log into the website and you can download yourself. So literally you cut the cost of running all this printing too. But what is impact is, let's say printing industry is a declining industry, right? What is a growing industry? AI is a growing industry. So knowing what is this trend and all things. Porter 5 forces is a little bit more complex. Maybe I can share you what is actually Porter 5 forces. Let's see. Okay. This. Let's see. Okay. Porter 5 forces is about bargaining power on the different places. The industry rivalry, threat, substitute, buyer, new entrants. It's a way business always measure how strong they are, how weak they are. We look at the buyer side, supplier side, new entrants, and substitute. and of course, within yourself, how competitive and all that too. So that's kind of the few things that determine the thing. Of course, then you have macro economy. We recently saw the debt, 20 years bond price, sales was bad. Yesterday, market down, US. Those are the macro factors that affect it. Global trend is the currency moving favorable or non-favorable. So those are the things that will impact. So with that, of course, you have all these different valuation method, PE, price to book, discounted cash flow, comparable analysis, and on all this area. So those are the things that give you, it's a bit of repetition that we talked about it earlier on, the PE less than 15, gross margin greater than 40, cash flow, if it's stable, stable, uptrend on operation cash flow, free cash flow. So just now, Ray asked about free cash flow. So I guess the key words is it's always talking about whether it's a stable, it's uptrend in operating cash flow, and the free cash flow means after you put aside, consider that you have to spend on the capital expense, you can still have free cash flow. Typically, this is a stronger company. Okay, a free cash flow that is negative usually means that they had to borrow some money in order to expand. Okay, so there's always means that it's not as favorable. Doesn't mean that it depends on industry. Some industry like the TSMC or the heavy industry that invested every few years have to invest, they may have quite a bit of financing they need to continue to do. But their gross margin or their business, like I think their net margin is 30% on their selling or chip, they were able to cover back some of their financing costs in there, but they still need the financing costs in order to grow the business kind of thing. So that hopefully helps to answer one of the questions that you have over there. The other one is the Burmese castle in you're talking about the castle view and all that, don't worry. Yeah. Efficiency is the other one I mentioned earlier. What's ROA, ROE and all things. Leverage is the other area that we briefly talked about in the ratio side. But again, these are metric used for valuation. This is less used, discount cash flow, but yet it is one of the most, I would say, for more sophisticated or for more complex or more detailed analysis of a company. Typically, they use discount cash flow. Okay. Even when as a corporate, where we look at a certain project, whether we want to launch a certain project, we also use discount cash flow. Let's say we want to launch a satellite product. We will do a bit of projection whether this product, how much volume we will be selling, how much sales can we get, what's going to be the cost like, and we use a certain assumption. Again, discount cash flow has a lot of assumption. We certain assumption of what is the cash flow in the next few years when the product is launched, or when you're buying this company, you're looking at this company in the next few years, how much cash flow it can generate for you. And then you calculate it from the past future cash flow, which based on the interest rate and the expected discount rate, what will be the value of the business. Then you calculate what is the right markup or right price you're willing to pay for it. More shrewd business people even can buy at a discount. I know some shrewd SME are very good. He even buy a factory with the, I wouldn't say a discount, but he bought the factory with the business such that he worked with the arrangement of the persons. He owned the brand, but he let the people use for a certain period of time. And literally he get the land use of the factory for the 30 years. So this is one of the few entrepreneurs are very impressed with his capability of that area. Again, the other one is PAC ratio. PAC ratio is a very interesting ratio, sometimes useful only when you want to compare different sets of company. Because fast company and moderate company and slow company, their growth rate is different. You can see this growth rate is different. But because their growth rate is different doesn't mean their PE high means it's not worth it. Sometimes in this case, you see the PAC is lower than the other two. Actually, it could mean that it's even more, if their assumption is right, their growth is going to continue to grow that well, and even their PE is high. it's still worth to go in, which is why, why certain company like example Nvidia in the past, because it was a fast growing and people are willing to pay very high PE to buy the company. Okay, so those are the interesting situation that causes people to jump into it. Of course, the other area is good comparable company comparison. So again, this is a quick summary of what I would say. We use number and narrative and combine quantitative and qualitative analysis to come up with something that that makes sense. But again, this we always start small, start simple. Then you combine multiple tools. Then you focus on value, not price. As I always say, Buffett says that Warren Buffett says, your price is what you pay, value is what you get. In the fundamental analysis, what you're trying to get is what is the value of this company, and look beyond the current market sentiment. Whenever there's a crash, it's always the best opportunity to explore. Okay, so that's kind of first three part. Well, I completed almost in time. Right now is about close to 9 o'clock. Are you guys okay? Any question for now before I kind of close for 5 minutes break and for me to take some water and come back? Any queries that, as I mentioned, today's session is fundamental. There's a lot of theory there. I'm confused about EPS calculation. Okay, let's see. EPS, what do we say here? Earning per share, okay. Yeah. It's earning or net profit divided by total share. So when I mentioned the simple calculation is, of course, let's look at maybe let's see whether we have the let's see. So if let's say this is SGX, right? Their earning is 350, 340. Okay. Their outstanding share, whether I can see from here or not, the market cap is here. Common share outstanding. So you see that this 1 billion share on the outstanding. So if you take this, okay, this is not exactly correct because this is per quarter. So we're taking the annual one. So the annual one will be 597 million divided by the outstanding shares in the market company. Outstanding share here 107, 1 point something billion. That will come out with the EPS in here. See, it's quite 0.559. This is where's the net count? 597, right? So it's around that. That's how it calculated in a simplistic way. Okay. Again, sometimes we don't want to do that. There's a lot of things that we can do online and put it up. I mean, investing.com is one of the areas I love to just pull the information. It helps you to calculate on the latest number in there. So you don't have to look at it. But we always do a cross check if it makes sense, whether it makes sense or not. Okay, what's the other question? Which valuation metric for use for which company? Example, should use P or price to cash flow, price to sales, to value growth. Very specific for Google. I would say price to sales is quite important because because it's quite a lot of thing is the sales is exponential or more a good way to see how they are growing fast enough. Again, different company you will need to. Sometimes I do a cross check on both. But my first cut will always be PE first. That helps to look at the number and whether it makes sense or not. And then I look at the PSP. Price to cash flow less used for me, even though it's very useful. But I look at the cash flow statement, particularly whether it's positive cash flow or negative cash flow. Because a typical positive cash flow, so even investing.com, you go to financial summary, you can actually pull out their So just now I showed you is under POEM, you can see the cash flow, but inside here you can also see the cash flow from what do you get from operation. You see cash flow from investing, cash flow from financing, net change in cash flow. So if this is positive operation, typically and growing, typically is much safer. Okay, but if it's going down and become negative and you have a lot of cash from investing, then cash from financing, then you have to be worried. In this case, cash from financing is negative, means they are paying back some of the loans. So they are reducing their past financing and all that. So okay, this is one way. Of course, you can go to POEM. You can also pull out some of this information in there. I think it's under cash flow. You can see all this thing down here. Cash flow from different area. Okay. So I read your description as earning divided by net profit, then divided by total. Oh no, here. Sorry for that. I think because I think the presentation is two part of it. Probably that. Thanks for alerting me. Is total earning in the annual report for the period divided by total outstanding share. Is either this or this. I just kind of wanted to say net profit divided by total share. Okay. So I think we kind of eat a bit onto the 5 minutes, but any other question before I let you guys go out for a bit of a 5 minutes break? Are you guys okay to come back about 1:11? 9:11, sorry, 9:11. 9:11. That's kind of scary. 9:11. Okay. So I see you guys about 5 minutes time. Guys, yes, about 9:11, 5 minutes time. Are you guys ready for the next session? Yes, maybe type one. Uh, Not I shall start. Okay, cool, good, great. Welcome back, welcome back. I got a chance to pack my bag a bit because I'm flying off tomorrow to China. So that's why a little bit of trying to meddle with both sides. Again, back to next part, technical analysis in investment. Why technical analysis is important? I think understanding a pattern and trend could help to predict a bit of the future price movement, but it's not guaranteed. But it does focus on this. We look at because there's a study of past market mainly because of the price and volume movement. Okay, this is always talking about this keyword, price and volume pattern. It predict a bit of the future movement. Okay, and interestingly, market actually psychology sometimes create recurring patterns. So that's why you can use it to kind of a bit of if you're a good technical player, you can actually predict a bit of the chances happening and all those things. So example myself, I was looking at treasury yield and I looking at the short-term trend and the mid-term trend. I say, hey, this doesn't look good. It may be the treasury yield is moving up, even though it may be coming down. So I will start predicting myself, but sometimes I may be wrong. Okay, so technical can be used more for almost stocks, forex, almost anything. But as long as there's a price, there's a volume, there's a movement, there's a pattern, it can actually determine certain area like that. Okay, but it's not 100%. That you should not be blindly following without knowing the rationale behind it. Okay, so that's something that I want to caution. So that's why knowing how to look at technical trend is important. So the core principle of technical is always about price discount everything. So all known information, see people know certain information, then they will buy or they don't buy. So uh, uh this might not be a good way of saying in here, but in any stock market or any purchases, somebody gain, somebody must be losing. It's a zero-sum game, you know. If you buy at a low price, you sell at a high price. Somebody had to take over at a high price, right? Hoping that he will be higher. So it's a bit of a zero-sum gain. Of course, there will be costs involved in the transaction too. But by the movement of the price and the volume that has been transacted, it does help to give you a certain idea where it's moving. And price always move in certain trend, uptrend, downtrend, or sideways. And I mentioned history repeat itself again. So face three key charts on three key chart that is being used is the line chart, the bar chart, and the candlestick chart. I would just kind of one show more on the closing price only, simple trend visualization because this is a line. The other one have open high, what they call opening and lower close kind of data. And then more price information, and of course candlesticks do a bit more sentiment and the most popular choice look at this way. So this is example of a line chart. Just look at closing price. So where is it? Looks like and high low open close kind of price. Then you can see that this is the end. Open here, close here, the high side, the low side kind of thing. But you don't know whether it's up or sometimes not so easy to see whether it's close up, close down, because you can see by the line sometimes may not be as clear. But when you come to candlestick, it's become more clearer because so there's two type of one. I mean, not say two type, but there's different visualization. Anything that's white typically means open lower, close higher. Anything that's black, open higher, close lower. Something similar. Some people use blue or green and red or blue and red or whatever it is. But basically that's kind of a bar with a rectangular shape for easier reading. Okay. Of course you can click on this link and can understand a bit more. this is more the terminology in there where you talk about, what exactly in there. Of course, the technical analysis I attended before is a 2 days course. So today we are doing it in 1 hour, so or less than 1 hour. I can't give into the depth of how to look at doji, how to look at candlestick art, what are the different trends. But I want to share is at least the general concept behind it, general concept and general things that you look out for. And I try to provide as much link as possible. If you could, you can also check on those things. But of course, maybe in future we can provide a more advanced course on this area. But today, of course, within the restriction of time, we will try to provide as much depth in there. So next is part 5, which is more identifying trend pattern, key technical indicator. Um, um, First, what is trend? Uptrend, higher high, higher low. Downtrend, lower high, lower low. Sideways, no clear direction. Don't know whether go up or down. Sounds simple, right? Sometimes it's easy said, but sometimes not so easy to this is still easy. Pattern is the one that is kind of more difficult to pick up. So if you look at the higher high, higher low, this is much easier, when it come up, can go up, swing high and swing lower, but this low is always higher than this low. So we call it higher high, this high is higher than this high. This low is higher than this low. So it's higher high, higher low, and it's kind of showing this uptrend. Okay. But with the downtrend, it's the other way around. So basically, started high but closed low. Then the next high is never over the high of previous high. So that's kind of showing a downtrend. Simple, right? But sometimes this is a simple line chart. When the actual one, it can be like a lot of candlesticks start and become less visible to you and all things. And then if you look at a window very narrow, if you saw the tree but you lost the forest. So that's why sometimes you need to see it in a different perspective in order to understand where the trend is coming up. Okay. So the other area of technical analysis is called the support and resistance level. What is a support? A price fall there where buying interest is strong. So things that there's certain buying interest to continue to support at that level, often the previous low. Okay. So people become conscious that when you hit that price, it's a good low price, people will come in to buy. So it's a price support line. Resistance is where the last time it hit that high, it doesn't cross, it cannot cross. It's kind of a ceiling down there. There's a bit of price pressure in increasing, in crossing the thing. So it's a resistance. Price move above the resistance or below the support is called breakout. You break out from the standard level and all things. So I'm going to jump a bit more on the technical information. So if you look at number 1, there was a major surge. You notice that there's a major surge in the volume here, right? And corresponding, this thing closed up, okay? But there's no support or resistance line that was broken because the resistance line is here, right? The support is here. So it's kind of in the range, right? So it just shows there's a certain interest. Then you have to wait for the next day. Did it break further up? No, it didn't. It come down again, right? So then it actually came down. So basically, this is a time where you say, hey, looks like there's some problem. Then you also look at the volume. Hey, maybe the volume not so big. So it's okay. Let's see the next day. Then break up. So this become a range bound, right? Range bound in here until it confidently breaks. So like the price in number 2, right? You will notice that the volume, this is a forex one, if I remember correctly. Yeah, this is a US dollar, Japanese yen. So I'm kind of trying to show you that it can be used in currency, it can be used in stock, it can be used in any many way. The price of the forex pair suddenly move up, right? And it break above the resistance level. So that means it break from the past range bound, pop, go up. Okay. Then it's very important to see the next day, breaking through the resistance. A closer look at the volume. It does say, okay, the volume seems to show that the volume is high and increasing. Yeah, you see it's going up, right? So there is good chance that it's going to move up. So that's kind of a good good positive momentum there, I would say. Okay, so that's where you observe, or you can decide. You see from lower volume going up, and you can decide on this point to do here, or you wait for the next up. Some people call it you wait for the next confirmation before you jump in. So after this breakout, if you confirm breakout, then of course there's a strong breakout from there. So the high increasing volume is a signal that the breakout is valid. Trader would have taken a long position on some of this area. That's why you need to watch it. But you notice down here it start to drop down. So okay, because but the initial volume is not so high. But then as you increase the volume, that's kind of worried. So currency usually also by people playing it. And the difference between stock market and forex market, I would say, it takes a country to move a forex, or it takes a big amount of money. While a stock, like I seen, like in Malaysia stock, sometimes you can move a lot because it takes small sum of money to move it. There's insider trading and all things. But forex is a lot difficult. Okay, so the item area on the tree area. So this is where it break down. The bearish trend is break through the support line, right? And then the volume also continue to increase up, right? So it's that means it's losing its ability to hold on this level. It continue, the people are dumping, that's why. Until this moment it come up, but there's still not enough. So this become your new resistance line. It doesn't go up again. So that's why you have this support and resistance. Okay. Of course, this is a simplistic one of the US dollar, Japanese yen. I cannot pull it out. In fact, today, if you look at the, let's see, you can look at this live thing. Sometimes we like, oops, what's this? Sorry, I need to remove all the things. Okay, so this forex. Okay, this is forex, US dollar, Japanese yen, right? Of course. Of course, this is Futumomo. Everyone can different platform. I'm using this because it's interactively much more easier. And I can change the what you can have moving average and everything quite easily. And I can change to 30 days or 30 minutes chart, or whatever it is, much easier. And this kind of give me the feel much faster, and I think like example US dollar index. One of the index that I watch very closely. I always look at the 30 minutes because the movement is much faster and all things. Instead of 50 period, I use 40 period, and that's individual uses differently. And then I draw this line, which basically, if I remember correctly, it was a previous low or something like that. That's why I have this line drawn out there. A long time ago, there's a line that was there. I think it was some major event that I cut through. So I draw the line over there. Okay, so what I'm trying to say is that technically is one quick way to see the momentum. Where is it moving? Okay, the last few days, this US dollar had been down. Okay, and it might be consolidating and moving up. So that's one area. So now we use the example US dollar, Japanese yen, right? The day, if I look at the day chart, this is another thing that I may not have covered in today's presentation. There's this thing called the golden cross, which is basically a 50 days more, the 200 days, 50-day crossover, the 200 days, either upward or downward. A golden cross means it go up, means it's uptrend. When a death cross means it come down, means so when the death cross, typically it means that the trend is going down. Okay, in this case, when the trend is going down, means the currency is appreciating, because it's US dollar against Japanese yen. That means US dollar is weakening, but Japanese yen is strengthening. So you need to know how to look at it in the right format. But it gives you the idea where it's moving. So hope this helped, but just kind of a bit of detour, but kind of explaining support and resistance in a way. Because if you look at this support and resistance, just now I draw the support line. This will be a strong resistance line here, strong resistance line here. If I draw a line across straight, likewise, this is a support line here. Okay, because you notice that it hit here and it went up again. It hit here, it went up again. So this is a strong support line here. Okay. So I hope it helps by giving a live demo on some of this. that apps is actually a Futumomo. I'm also I also trade in Futumomo I like to use their apps partly because of its interactive charting capability. Okay, so that's kind of a bit of detour. So next is common pattern, head and shoulder, inverse head and shoulder, double top and bottom. So those are the things that will take a bit more experience to gain knowledge. This head and shoulder usually means bearish reversal signal, and then a bullish reversal signal means inverse head and shoulder, means it's going to turn bullish again. This is like it's going to turn bearish. Bearish means it's going down, it's going up. This is when there is a major reversal signal, double top, double bottom. Okay. Nothing beats showing this actual kind of neckline or thing. So in this case, this is a simplistic way of saying that you will notice that this price movement is going up, and it hit a certain point, peak point, and started to come down. Then it started to go up again, but it doesn't break higher and higher. It started to slide. Then you notice there's this neckline that we will draw, and they say, okay, this between these 2 points here, there's a neckline. Does it break down? If it break down, means the chances that is this head and shoulder is a bearish sign. It's going down because this is like the head. This is our human shoulder. Okay. A reverse head and shoulder is the other way around. So basically, this is the reverse head, reverse shoulder. Okay. And it again using these 2 points, and then you draw the neckline, and then you say, hey, whether did it break it up? So a bullish reversal is here. Okay. So likewise, there is this thing called the double top, double bottom. I don't have, I didn't, because there will be too many slides. So this is kind of a bearish double top, something like you go up, keep up, and you start come down. Okay, then there's this is called bullish double bottom. So it's like coming down, then hit up, then come down. So there's a two bottom, then likelihood is going to go up again. So this kind of pattern people pick up. Again, just now, like let's say I use the Forex one, right? You can't really see a real neck, but there is a bit of like this is the head, this is the shoulder, and you draw the line here, and it break down. So this head and shoulder, it break down, right? So it become a negative trend. So that's kind of you must play enough or experience enough to catch the trend. Okay. Again, back to the slides. This is a more simplistic way of explaining what's the thing looks like. Okay. Oops. I can't move this thing. Okay. Sorry, I'm trying to move my cursor. It's blocking my view. The other area, this is called continuation of patterns. There's certain flag, there's certain pennants, there's certain descending triangle, ascending triangle. Again, it's a different pattern that kind of show up. This is kind of showing a brief pause against the trend. This is showing converging trend line, flat bottom. Nothing compete by showing what typically is. Again, this one you can Google or you can type this thing in, and you can see the explanation of all the different charting type. So this, if you look at it in a certain pattern, we should look at the pattern together with volume. So you always have to look at the volume, especially for stocks. This is like the trend line is showing more upward, but then suddenly it come down, but it's slightly more a bullish flag that it will continue to go up. Okay. A similar thing at bullish pennant is that it come up. You can see that you can draw a line that is kind of narrowing. Likely it's going to push up. It's just like consolidating. It's the energy consolidating before it move up. The key thing is this moving upward or is it moving downward? Okay. So it could be the other way around, like this one. You have bearish flag come down, then it go up a bit, go up a bit. Is it going to go up? Is it going to break it? If it didn't break it, it go down. Okay. So what is it's characterized by a sharp price movement, the pole, followed by a period of consolidation. They create a continuation of prevailing trend, whether it's bullish or bearish. Okay. while a bullish pennant and a bearish pennant is more a symmetrical triangle that resemble pennants that kind of brief consolidation. It means it's kind of getting narrow, building in energy before it build up. Okay, ascending and descending triangle kind of similar, but yet it is not guaranteed it's going to go up or down. Actually, it has a horizontal top. The key word is horizontal. A descending triangle is a horizontal bottom. Okay, and is descending within a trend line. Both can break in either direction. This is the case where you're not sure whether it's going to break up or break down. Okay, this is more likely bullish because this is kind of upward, or rather, there's a certain this uptrend in here, while the other one is not so clear because there's a flat top on that, while this one is a slanted kind of thing. So this again, as I mentioned, sometimes even me myself, I may not use 100% technical, and I'm not 100% purely looking at technical, but I just kind of get a few of it and roughly to get an idea whether is there a certain pattern. The head and shoulder is one easier. This one's a bit more complex to understand. Okay. Okay. So next is key technical indicators that we use to understand the trend and all things. There are things called moving average, and then there's a relative strength indicator and MACD. So basically all has this purpose. One, identify trend direction. A lot of common thing is 50, 100, 200. Just now I show you, I use this differently for a shorter term because sometimes it's more of individual preference, your experience, you pick up different things. So there are people use 22 days versus 20 days because they think a month is 22 working days, not 20 days. So there's different way of looking at it. Okay. And some people use 125 days instead of 100 days because 125 is closer to a 1 month, 6 months rather than 100 days. So every individual has a little bit of preference of, but this is more the major people uses this. Okay. Of course, relative strength, we'll talk about it shortly. Momentum indicator is also MACD, is a very common thing. There are many other things, KDJ, there is other kind of indicator, but these are the more common ones we should be familiar with, easy to. So let's say this one, 50 days. 50 days is equal to the average price that, basically it's about 2.5 months. And it's kind of a use of a support level, whether it does cross here, does cross there, and all things. So it's kind of a good 2.5 months, whether it hold there or not. While the 100 and 200 is about 20 to 40 weeks, respectively. So you know, this is not one whole year. It's 40 weeks because 5 days to a week. So 200 days is basically 40 weeks. So that's why sometimes people use 125 days as a 6 month rather than a 20 weeks count, right? So everyone uses different way to, but because a lot of technical indicator people use 200 as one of the long term. Short term people use 20 days. 50 days is a good mid term or mid short term to see the 2.5 month movement. And it's a way of saying that if you can sustain a certain way at 2.5 months, this is the trend let's move to. Okay. So next is RSI. What is RSI? RSI is actually a momentum indicator. And it's actually in all this you can Google in Investopedia. You can have a very more in-depth explanation there. Okay, but then kind of capture some of these things. So one of the key thing about RSI that we usually look at is the overbought, which is above 70, and the oversold, which is below 30. So they oscillate around here. But then if it suddenly shoot up, means is overbought. That means people overly bullish and continue to buy. It may have a high chance it will need to correct down and upstick. So, but it may not be. Some bullish one can continue to stay high up there. Okay, so, but then it's just a standard deviation or common common pattern that will happen is when it hit above too much, it will come down. Okay, so that's why the 30 and the 70 is always the key area we watch out in Austin. Let's see. Next is momentum, which is MACD. Again, this is also interesting. There are platform. I used to use Thinkorswim, which we can even change this 26 or 12. Sometimes we change to 8 and 22 or whatever it is. I can't remember the number, but we adjust it because it gives you the signal faster. Okay, but the standard is always 26 and 12. Okay, it's exponential, moving average, and closing price, and all. The key word is, or the key thing is a signal line. Okay, it does show the change in certain momentum, the signal line. Okay, so when cross over the signal line, it means bullish, and cross or down, it means bearish. So that's kind of the signal is trying to tell you. And the other one that may not mention here a lot of time, I call it, if it's above zero, usually it's still strong stock. If it's constantly below zero, typically it's pretty weak. Okay, that's kind of a quick explanation of three key indicator: moving average, RSI, and MACD. And as I show you earlier on, even in this one, you can see that there's also MACD and RSI, right? So you can notice that Japanese yen, US dollar, Japanese yen is already staying negative territory. It means it's on the US dollar is weakening, and even the RSI is below 50 most of the time. So that's kind of also give you an idea where is it. And also you see it's below the moving average some of the time. Okay, so that's kind of a quick learning, teaching about this thing. Oh, I uses SGX again as example. And if you look at this example here, you will see that it has been in the previous module I mentioned about accumulation, right? This kind of the accumulation phase, people just sideways, volume may not be very high, and suddenly, oh, it cross over or it start pick up more strength, RSI pick up, and then it broke the moving average, is on the uptrend, right? And then after that, another second phase of sideways, right? And then until here, then it has a sharp change in the volume. All right, here also have a sharp change in the volume, but then it seems to dim down, but then the volume quite quickly go down. So it didn't really, if the volume continue to go up, that means this thing will go even further down. Okay, so that's kind of a bit of that feel, but again, here you can see that this is overbought already because it's jumped too much, right? So likewise, you see this big volume here. So it jump up. Histogram is another way to look at it, but let's keep it simple. Just using the signal line, which is the blue line, cross over the red line, it means it's kind of bullish. Cross down means it's kind of weakened and all things. So likewise, you see this big drop down because of volume pick up, jump, but then it start to cool down, and then it start to pick up again. Okay, so let me ask you, where do you think it's going now? Today is here. Okay, it has crossed below the red line, but there's very little volume. But MACD is down. It's close to 50. So today is mainly driven by the US market down. My take is that we shall need to see how the next few days it looks. Okay, but it's certainly not as strong because its MACD is kind of pointing down. This is close to 50, and it just broke the 20-day moving average. Okay, but again, because the volume is small, it's not a panic selling. Okay, it's not a panic selling. So those blue trend line are support and resistance level, right? Correct. Yeah, you're right. So different times that you uses the first support is of course the 20-day. Then it break the first support, it will go to the midterm, which is the 50-day. This one, the green one, is not the 200 days, because I think it's 100-day. Yeah, it's 100-day moving average only. Okay. I didn't put out the 200-day average. Okay, hope this helps. Only 47 slides, so I better be conscious not to overrun. Okay, next. Oh, summary of key takeaway already. Not too bad. actually finished most part of it. Okay. So in this case, we study the past. Technical analysis uses historical data to predict price, master the basic, understand the trend, the support resistance pattern combination, and of course, combine indicator to look at where to confirm the trend. So maybe at this juncture, let me just kind of jump into the same chart, but let's look at the US 10 years U. Okay. 10 years. Oh, we are into the market already. Sorry. Okay, so if you look at the 10-year yield, I draw a lot, couple of resistance and support, right? So this was one of the resistance, and it break out, it came down. So this will be one other resistance, whether this thing will be testing before or it will be hitting here and coming down. Okay, so it could be one area that 10-year yield will hold off and didn't go. But sometimes this is a day chart, because day chart means you can only see at the end of the day. So sometimes I change to 30 minutes or even 4 hours chart to give me an idea. And why I change to 40 period and all that, because it's kind of after certain experience or whatever, it's to kind of give an idea that in the case here, it seems to point towards a short-term uptrend, unless this 200 period blue line is the main support that it break down, it will tendency to go down. But if it bounce back within because it's a half an hour kind of chart, usually you also need to look at the MACD to see the direction too. You kind of combine the two things to see where we. So if I look at this, I mean, US 10-year is still on pretty strong uptrend. As you can see, it's hovering above the yellow trend line. Okay, this is a 30-minute chart. If you look at a 4-hour chart, let's see. Let's see. I need to change to 4-hour chart. Okay, I use 4-hour chart. I use the same 40 period moving average as this become the main support line, because is 4 hours, so usually it doesn't change too much. So this 40 period become the main support. If we break down here, it means it's even worse. So you can see that it's also showing an uptrend. And the other thing is that if I look at it, you see this is all above zero, the MACD. This is mostly RSI above 50. So it's still on a pretty sadly uptrend. Okay, so those are the way how you use it to look at the thing. So I hope it helps to give you an idea on how to understand this. Why you use 20 and 50? Why is it individual interest? 20 and 50 is a common short, medium, middle term trend line. And if many people uses 20 and 50, I was referring to the flags. Okay, the flags. Ah, just now we mentioned about this flag, right? Bullish flag and all things. This is where you see a certain trending, but it's still on upward trend. Let's see whether I can see from this. If I draw a line here, let's see whether I can draw a line. Let's see. Let's see. It's a horizontal line. See, this is one line. Oops. Do another. This is more like a bullish flag. So it came down, came out. Okay, but likely it will be similar to. Wait, let me see. I can go to the slide presentation. Sorry. Yeah. Okay. I lost it. Okay. Up, but this is down. This is more this way. Yeah, this is more this way. More like closer to a trend this way, but then okay. So this is another pattern that it's not called a bullish flag, but it's also another way to. This is kind of in the triangle before whether we may not know the direction of this thing. This is very similar to asymmetrical triangle, but they don't have a horizontal, but they have a kind of diverging kind of line. So that's another way to look at where how the flag's going to move up and all this thing. Okay, I'm gonna have to remove this, otherwise I will confuse myself with this. Okay. Bear with me. Okay, switch back. Okay, so I just kind of quickly show some example of how you use technical trend. You combine different things. You look at support, resistance pattern. You look at MA. You look at MACD. You look at RSI. At certain time, I even use KDJ. So actually, the same thing can be done in Poem. So if you go to Poem, you can always do charting. So let's say you just type okay, you just type let's say. Sorry, just type S68. Okay. And then I just did. So you can come up with a chart. Of course, you can change I use another indicator, KDJ. KDJ tends to be faster. The movement tends to change faster than RSI. RSI tends to be slower. So I do use other indicator. I even have a paid platform that uses another indicator called SMI, which is more on smart money investor index and those things. So that's more complex that we will not cover today here. Maybe in future on the advanced training. Okay, so hope this helped. This is a summary of the key takeaway. Next section is practical application, fundamental. I mean, along the way, I did kind of give a bit of practical application, how you look at it. Example, SGX, fundamental analysis, right? I mean, you want to compare to a similar company between in the industry. So SGX is Singapore Stock Exchange, Hong Kong Exchange is 0388. I think this is their report is this January. This report is last November. There's a bit of timing difference in what it is. But sorry, I pressed the wrong button. Okay, but the key thing is this is the few thing is I will look at is the growth rate. Okay, EBITDA growth rate. You know, if you look at this EBITDA growth rate is 10%, it's 9%. This is only 3.1%. So obviously Hong Kong Exchange is growing faster, right? Likewise, EPS is growing 4.4. I think the earning per share is earning about 10% more. Okay. And then of course the size of the business is 22 million, but it's in Hong Kong dollar. If you divide by 5, it's about 4 over million versus 1.2 billion. 4 billion versus 1.2 billion. So it depends on how you look at it. And of course the margin, you can look at the margin too. This one versus this one, which is higher, right? So a fundamental analysis will, if you do a comparative, which is a better bet and all that thing, then you are doing this kind of analysis in that sense. Okay. Again, it's just a way of gauging how good is this company. If I would look at this company, of course, in China or in Hong Kong is not doing very well. You see, deep down before it go up, so there's a big dip onto it, and that's understandable during the COVID, right? So as long as we understand what's the reason behind the thing, okay, then we can figure out does it make sense to go in or not. Okay. But again, the other area I look at, I also extracted some of this from investing.com. the area of their PE. So you see, Singapore is only 22 times, but Hong Kong Stock Exchange is 34 times, a lot more expensive, I would say, a lot more expensive. But and their price to book is 7.3 versus 9.5. So if you look at that, yeah, maybe Singapore is worth it. And the dividend, I think, is 2.6 versus 2.4, right? So, but if I look at gross margin, 87 versus 95, right? And then, of course, sometimes I also look at date. They just announced earning. The next announcement is August. People will anticipate the announcement and they will, decide whether to go in or not to go in and all things. So there's fundamental analysis, you can look at it. So one, grow faster, but the PE higher. One, grow slower, the PE is lower. So we can actually do what? PEG, PEG, right? PEG, you can look at the growth. Remember early on, I mentioned about the other way to measure the comparative or different industry and all things. Now, in the case here, is different market or different places. Then you can look at it, whether which one the PEG ratio is better. Actually, is it investing.com or the other one? It does give you the PEG ratio. I think it's the not Guru Focus. What's the other one? I can't remember off my mind. It will come back. Yeah. So this is one way to look at it. So I also pick up another one from a technical indicator and all things. This is one that everyone is familiar, called NVIDIA, right? I mean, NVIDIA, I pull out a chart from late 2000, October 2023 until now. You will notice that last module I mentioned about consolidation or accumulation phase. See all this volume in there, not much movement, people are accumulating, and this is also flat. Doesn't really move a lot higher. But you notice when it's sharp out that time, all MACD always above zero, right? You see the MACD always above zero. And then this is even overbought. But it's still going up because you see the volume is supported. There's a lot of volume in there. Except for this area, maybe the lower volume. That's why you see a dip here, slight dip here, right? But most of the time, slight dip in here. That's why you have this dip here. But mostly it's up, right? Because it's staying above here. Then of course you notice another area. If you are sharp or you experience it long enough, you see the volume go up. This green line here is the average volume for the period. I think it's for 1 month, if I'm not wrong. Exponential moving average, which is 22 days, if I'm not wrong. So you will notice that it start to come down. So although the price is going up, but the volume is coming down. There's a divergent. We call it a divergent. Divergent is kind of a trend. It may mean there is some possible changes in trend, or there may be some overbought or certain thing is pushing it up, but maybe a bit more risky or a bit more uncertain. I would say maybe called uncertain, right? Over here, I also draw some high line, which is probably going to be their what do you call that? Resistance line. This thing will have to break this thing, right? So you notice that here is one of this support line. Down here, it was hovering around here for a period. That's why when it dropped here and bounced back again. Okay. So even though the support, maybe it's a time when you come to here, you say, hey, maybe I can take a bet. And you see the volume is not as high, but then and the next day the volume pick up in buying it means there's a chance of picking up. So those are the technical trends. Those are more sophisticated that I'm not covering today, but you also notice that if this MACD used to be always above, now it's always below. Except for recently, after Trump announced tariff delay, kind of more delay and all things, there is also the AI tech protection and all things, it continues up. Okay. I think their earning, if I remember correctly, is 24th or 28th. Let's see now. And we shall see whether their earning will be any impact to us. Let's see. So if you want to play with this, you can always at investing.com, you click here, you go in and you can see the data coming out. It's a bit slow. Okay. Sorry, I think I may have double click and we have gone to another place. Oopsie. Mention. Okay. So you notice that the next earning is May 28th. I was correct, May 28th. So this may be a period people are bullish and pushing it up, so you will have to be careful. So sometimes earning date is always a more volatile period. Okay, but again, this is example I just want to share with you. There's a fear impact and the greed that kind of drives some of this thing. Even though there's a divergence, people are still greedy and pushing it up higher until suddenly you see the volume has dropped so much, then it's just, and of course there's I think if I remember correct, DeepSeek announced news here. So when DeepSeek announced the news, you see there's a gap down. Another indicator is called a gap down, or rather, you see there's a big gap here. A gap down is a big drop down from there, which is typically a strong support or strong resistance to break the gap. So it hover around here before it break out. Okay. Yeah, so that's kind of the key area. Next one is I kind of put in here some free platform. I just kind of demonstrated investing.com. The other one that's good, pretty good is Morningstar. Actually, Morningstar do give a very good almost every country if you can Google and you just got Google and say Morningstar, what company, what's the financial ratio, they will come out with a report of 10 years, their information, which sometimes include PEG ratio, PEG, which will be helpful to know. Okay. Another easy way you can use the screener within investing.com. Even Poyo also have screener too. You can screen for stock that you want to have certain ratio or whatever it is. So that's another way to use a smarter way to screen stocks. Another free platform for technical chart is TradingView. TradingView. I also use TradingView. TradingView for some of the key few Max 7 tech stock. I use it to monitor them and all things. So you can try it, and they provide free one for a few simple indicator. And they even can track. The beautiful part of TradingView, almost all kind of product is in there. Futumomo has certain thing that you can't find, like Malaysia stock or some area. Some I think they don't sell, they don't have. Okay, but TradingView is almost everything. Okay, so that's a beautiful part of it. Next, I will summarize the key gauges for business performance. Market evaluation, you can look at it. A PE less than 15 typically means it's still reasonably cheap. If you look at just now Nvidia, what's the PE? Yes. If I'm not wrong, is 44 times, right? It was even higher last year when it went sky high. Okay. A typical PE in the US market in the past is about 22, but now has gone up. So it may be under a bit on the higher risk side now. That's why be cautious of it. PB means usually in the asset heavy, or that means when you sell everything out, the book value of their asset is higher than the price that you're paying for, average price of the asset. Okay, so that's how you try to look at cheap and what's the margin. So again, this is just kind of guideline. Cash flow positive, uptrend is good. ROE, efficiency, if it's greater than 15, 7 for non-financial, 1 for financial, current ratio, and also this is guideline. Okay, nothing. And you need to build your own gauge yourself. I pick up this over the years, just sharing the thought. Okay. Wait, sorry. Okay, back to here. So I want to close with a few comments here. Warren Buffett always have this thing called circle of competence. So work on the company that you are familiar with. You don't have to be an expert on every company, but just a few that you know well enough. Initially, I was using Sunnydale as an example, which is a company that's delisted. I used to know the GM. In fact, he's still the CEO running the company. He used to be my ex-boss. So roughly I know where are they, what are they doing, how is his character of his boss, and whatever it is. So knowing the people is actually helpful too. So never invest in any idea you can't illustrate with a crayon. That's what Peter Lynch mentioned. He's also one of the guru in the past in investment. Circle of competence means not everyone is familiar with every industry. So figure out what industry you want to be more familiar, more interested, and you can play with it, the knowledge you have. Okay. Some of the famous quote: price is what you're paying, value is what you get. It takes 20 years to build a reputation and 5 minutes to ruin it. So some of the key thing that I kind of want to call it, risk come from not knowing what you are doing. So that's a key one. Learning fundamental, learning trend help to reduce the risk, but doesn't eliminate. Of course, I believe in continuous learning. Learn, unlearn, and relearn. So we always have to continue to learn. We simply attempt to be fearful when others are greedy and to be greedy when others are fearful. So the other indicators, sometimes I look at this greed and fear, volatility index. Those are the things to give me a guide. Are we on the fearful side, on the greedy side, or are we in the volatile panic side? So those are the things that helps to give you a gauge. Okay, so that's kind of few quick curve. And I always strongly feel that his golden rules, like never lose money. Rule number 2, never forget rule number 1. Easy to say, not easy to do. In fact, myself always sometimes being greedy, make a mistake. One other rules, not from him, but other people, is the 10% cut loss. A lot of people had the emotional bias or emotional burden they couldn't cut loss. A lot of time it make you lose a lot. So that's the other thing. Average up instead of average down. A lot of people like to average down. Oh, come down already. I think it will bounce back and buy more, buy more, buy more, buy more, buy more. In the end, you lose money. Okay, I'm gonna run out of my time. Personal investment concept, I call it MVT, macro, value, and trend or technical trend. Macro, because you need to understand the business, economic environment, rate direction, market sentiment, new trendy ideas. The other thing is valuation, understand the fundamental, understand the intrinsic value, compare the valuation, trend. You understand where the trend of the current investment, clue for the breakout, cross-check with the industry peer, macro news, and evaluation. That's my way of looking at it. MVT, macro, value, trend. Okay, that's kind of my last slide. Any question from you guys? I hope it's helpful. Do feedback if you think anything I could improve better. Any other Q&A I could answer? If not, a two other things I want to mention. Let me see whether I have the let's see. Okay, first thing is, as you have joined the community, there is actually a Arium, no, not Arium, Kajabi apps that you can download for as a community, and then you can chat within the community. So I would suggest you can use that as a way to hear from other people within the community sharing some of the ideas and all things. So that is let me see whether I can copy the give me a minute. I'm gonna unshare the thing first to go to another area before I jump back to here. Let's see. Okay, the community is, let's see, I need to put share again. Share, share, share. Okay, can you see on the screen? Okay, this is the community. Sorry, today I have not updated. We will send some more and more update. Of course, I'm one of the few key people that's sending and keep. In fact, yesterday or today I was thinking of sharing about the 20 years bond thing. We hope to use this as a way to communicate or to share this thing. This is on the website, but it's actually an apps on the mobile phone. You can look for it called Kajabi Community. And then once you use the same password that you log into the website, you can log in and you can see all those exchanges in here. So strongly suggest that you guys can play with it. This is one thing I want to share before we go. The second thing is let me see. I think it's June 5th, if I remember correctly. Let's see, what is it? June? Is it June? We will have an inside community meeting. I think Darren will send out a note on this thing. See whether it's exactly the June 5th or which day. Okay. Yeah, I think it's sorry, I lost the date. I must look at my calendar. June 5th. Yeah. Okay. So, I think we overrun. Sorry about that. Yeah, I think June 5th, if I'm not wrong, there's a community discussion. Either June 3rd or June 5th, one of these days. But we'll send you an email on those areas. Sorry for overrunning today. But I do hope that the presentation has been helpful for you. Any more question before I close the meeting? Oh, there's one. Where to find the intrinsic value of US company? It's not easy. It's not something that you can find. It's actually something I mean, there are people who create a platform to do it, but there's different people talking about value investment and how they calculate intrinsic value. The more sophisticated one is using discount cash flow. Okay. But the simpler one is using some of the what they call it, their current income, current expense, current outlook, and all things to calculate it. I've not found one simple website that can just quickly calculate the intrinsic value. There are, but some of them may not be I don't feel that confidently correct. Okay, so sorry I couldn't answer that question. So with that, I think sorry to overrun 7 minutes, but I hope today's session has been helpful to all of you. And I certainly hope that you guys will continue to join the Module 7, Module 8, Module 9. And do let us know, even in the community, anything that we could help on those areas. Okay? Have a good night. And adios. Take care. Thank you.
Recording stopped.